choosing where to invest your money can feel overwhelmingly complex. A world of colorful apps, confident websites, urgent advertisements all shout for your attention. Financial headlines promise to be the key to your future, but for a new investor, this noise can be paralyzing. It's easy to get stuck fearing a misstep before you've even begun. This guide cuts through that noise, offering a calm framework for making this choice. We won't recommend specific services. Instead, the goal is to give you a mental toolkit to evaluate any option you encounter. It focuses on the fundamental principles that matter most long-term. The aim is to help you understand what to look for and, just as importantly, what to ignore. Investing should be a long-term, steady process. The platform you choose should support that approach, not distract you from it with unnecessary complexity or temptations for constant activity. Let us be clear, the platform itself is not the investment. It is the container. It is the administrative layer that holds your assets. Yet, the characteristics of that container can have a profound impact on your experience and your ultimate returns. A poorly chosen one can add friction, cost, and stress. A well-chosen one can fade into the background, allowing you to focus on your long-term plan without interference. This guide will walk you through the essential checks and considerations step by step to help you make a quiet, confident decision. The journey into investing is a marathon, not a sprint. The initial setup, including the selection of your platform, is about building a solid foundation. By taking the time to understand the basics now, you set yourself up for decades of calmer, more effective investing. You avoid the common pitfalls that trap many beginners who are swayed by marketing instead of substance. This is your guide to making a deliberate and informed choice, ensuring the tool you select works for you, not against you, for many years to come. When you deposit money with an investing platform, you're placing an immense amount of trust in that company. The single most important factor before you even consider fees or features is safety. In the United Kingdom, the financial system has robust guardrails in place to protect consumers. Your first step should always be to confirm that a platform operates within this protective framework. This is not an area for compromise. The peace of mind that comes from knowing your provider is held to a high standard is invaluable and non-negotiable for any serious investor. The primary regulator to look for is the Financial Conduct Authority. A platform authorized and regulated by the FCA must meet strict standards how it operates, communicates with customers, handles client money. This includes rules about keeping your money and assets separate from the company's own funds, which is a critical protection. You can and should verify a company's status on the FCA register, which is a public database. If a platform is not on this register, you should not use it, no matter how appealing its marketing may be. Beyond FCA regulation, you should also check for coverage under the Financial Services Compensation Scheme. This scheme provides an additional layer of protection. If an authorized firm were to fail and there was a shortfall in the client assets it holds, the FSCS can compensate you up to £85,000 per person per firm. This safety net protects you against the platform provider's failure, such as fraud or administrative collapse. However, it's vital to understand what these protections do not cover. The FSCS does not protect you from investment losses. If an investment's price falls, that loss is yours to bear. That's the inherent risk. The protection is against the failure of the service provider, ensuring that if the company holding your investments goes out of business, systems are in place to try and make you whole. Always look for the FCA logo. After safety, fees are the most critical factor in choosing a platform. While they may seem small on paper, a fraction of a percent here, a few pounds there, their impact over an investing lifetime can be enormous. Fees create a constant drag on your portfolio's performance, and the compounding effect can mean tens of thousands less at retirement. Understanding and minimizing fees is one of the most powerful levers to improve long-term returns. There are several types of fees to look for. Account fee, sometimes called a platform fee or custody charge, charged as a percentage of your portfolio, monthly, quarterly, or annually. Dealing fees, flat charges every time you buy or sell. Charges inside investments not a direct platform fee, but depends on the platform's range. Funds and ETFs have annual charges, often called the ongoing charges figure. A good platform will make these clear. Foreign exchange fees. Be aware, if you buy assets priced in another currency like US dollars, the platform charges to convert your pounds. These FX fees are often hidden and can be surprisingly high. Comparing costs requires homework. Think about how you plan to invest. Investing a lump sum, small monthly amounts. Buying UK shares, global ETFs. The cheapest platform for one person might be expensive for another. No account fee but high dealing fees can be bad for monthly investors. Percentage-based account fees can become costly as your portfolio grows. Find the structure that's most cost-effective for your specific long-term plan. In the world of investing platforms, more features are not always better. Many services are packed with complex charting tools, live news feeds, sophisticated order types. For a beginner focused on long-term wealth building, these features are often just noise. They can be distracting and encourage poor behavior, like trying to time the market based on short-term news. The best platform for a new investor prioritizes simplicity, clarity, ease of use, makes it straightforward to execute a simple, effective plan. The most important feature is a clean, intuitive user interface. You should be able to navigate without feeling confused or overwhelmed. Finding key information should be simple: portfolio value, fees, performance. Buying or selling should be clear and unambiguous, all costs displayed up front before you commit. If a platform intimidates you, it's probably not the right one. Another essential feature: easy setup for regular investments. Consistency is the foundation. Putting money to work every single month. Do it regardless of what the market is doing. A good platform makes this effortless. Create a recurring instruction. Automatically invest a set amount from your bank into your chosen funds or ETFs on a specific day each month. Set it and forget it. Builds discipline and removes emotion from the process. Finally, the platform must provide clear, jargon-free information for a fund or ETF, underlying holdings, investment objective, total cost. Avoid platforms that bombard you with sensational headlines, hot stock tips, social trading features. The ideal platform is a quiet, reliable tool, more like a boring utility provider than an exciting social app, helping you stay focused on long-term goals without needless distraction. Choosing the right type of account is just as important as choosing the right platform. The account is the wrapper that holds your investments. Different wrappers have different rules, especially regarding taxation. For most UK investors, the primary account to consider is a stocks and shares ISA. An ISA allows you to invest up to a certain amount each tax year. Any growth or income inside it is free of UK income tax, free of capital gains tax. This benefit can significantly boost long-term returns. Most platforms also offer a general investment account. A GIA has no annual contribution limit, but it doesn't offer the same tax protection. Profits from selling above the allowance may be subject to capital gains tax. Dividend income above the allowance may be subject to income tax. For a beginner, starting with a stocks and shares ISA is almost always the most sensible first step to maximize tax efficiency. Think long-term when selecting a platform. Find a provider you can stick with for years or decades. Switching platforms to chase small fee savings is costly and distracting. Before you commit, ask some simple questions. Does it offer low-cost funds ETFs for long-term investing? Are fees fair and transparent? Will fees stay reasonable as your portfolio grows? A good platform should fade into the background. It's a utility, not entertainment. It should provide low costs, simple functionality, robust security. Verify FCA regulation. Verify FSCS protection. Test the interface for simplicity. Ensure it offers the account types you need, like an ISA. Focus on regulation, fees, simplicity, long-term suitability. Make a calm, confident choice. Then get on with patient, consistent investing. Focus on regulation, fees, simplicity, and long-term suitability. And remember that the platform is just a tool.